Well, consumer confidence dimmed further in March as the view of future conditions fell to the lowest level in more than a decade. The Conference Board's monthly confidence index of current conditions slipped to 92.9. That's a 7.2-point decline and the fourth consecutive monthly contraction. Economists had been looking for a reading of 93.5. Joining us now, Jennifer Lee, BMO Capital Markets senior economist and managing director. Jen, it's great to see you. So, looking at this latest confidence reading, obviously it is not the first. We have had a number of these so-called soft data points coming in not strong. What do you take away from that?
So good afternoon. Thanks very much for having me on. This is clearly a story about uncertainty that we continue to talk about day after day, week after week, and a story about tariffs and how it's going to play out. And it's interesting how, we've had the consumer confidence headline from the Conference Board down for 4 months in a row. And it was all, for the latest month, it was all centered on expectations. Now, although the current conditions component slipped a bit, it was all about expectations, which you mentioned hit the lowest level in over a decade or 12 years. And of course, inflation expectations ticked higher to a 2-year high. And this sort of matched what we saw in the University of Michigan's survey as well. Down, and of course the 5-year inflation expectations index there hit the highest level since 1993, which was a big eye opener. So this is all about people worrying about what's going to happen with prices going forward, and what do these tariffs mean, and how much is this going to impact what we're paying, at the grocery stores, at the clothing stores, or at the furniture stores, or wherever. So all this uncertainty is playing out, and this is what you're seeing, factored into all the consumer confidence figures. So again, hopefully we'll see some clarity coming up in the next, in the next couple of weeks. On April 2nd, that's the big day that we're all waiting for. So we'll see what happens then.
Jennifer, how people feel is one thing. What they actually do can be another. What is the relationship, Jennifer, as an economist, walk me through it, between sentiment and actual spending?
That's a great question. So it's not a 100% tight correlation, but for example, the Conference Board's expectations survey sort of has a pretty decent correlation with consumer spending. So, and of course it depends on, what the situation is when the survey is being held, what's going on around the world, if that's going to be influencing anyone's perceptions about their current conditions or what they're expecting for the job market, for example, going, in the next few years or so. So a lot of that's going to play out. So for sure, it depends on, how you're feeling versus what you actually do. And of course, we've seen some mixed data in the last retail sales report. A headline wasn't great, but when you saw some declines in certain key areas, like discretionary spending, for example. But places like retail, dining out as well took a hit. But if you look at the broader report, the personal income and spending numbers, that which we're going to get fresh numbers this coming Friday, that'll be an interesting one to watch to see whether or not that also plays out. So it's not just the confidence levels, but as you pointed out, it's how you spend, and it's also where you spend it on. And if I start seeing more pullbacks in areas like recreational services or recreational goods and services or dining out especially, you start seeing more significant steady pullbacks there, then you know that the consumer is seriously worried. But I mean, if you continue to go out, have dinner, have lunch with your friends, go out for drinks, then you can't be super uber worried just yet.
Well, and I thought it was interesting as well, who's doing the spending and how they feel is always important as well. And what I'm referring to is the fact that a lot of recent research has shown that the wealthiest Americans are doing the bulk of the spending, right? And so in that Conference Board report today, the only income group that didn't see this kind of a magnitude of decline in confidence was households earning more than $125,000 a year. Does that mean that that wealthy cohort, despite the pullback, for example, we've seen in stocks, is still okay?
So in theory, yes, because it also when you're thinking about things like grocery bills and grocery costs, this takes up a smaller portion of their overall income, whereas the lower income echelons, it takes a bigger amount of what they're taking in every month. So it's going to hit them the most. So for sure, there is going to be a difference in terms of income levels and all that. But, broadly speaking, again, we have to speak broadly in this case, the consumer is still in decent shape, but of course we're still watching for signs of a more significant pullback depending on how high prices go, how high the prices are going to stay at those higher levels, and then see how that impacts economic growth, because the consumer is, broadly speaking, again, the biggest driver of the U.S. economy. But certainly there's going to be some differences between the different echelons of income.
Jennifer, one question for investors, maybe it's the question, is they're trying to figure out the extent to which what we're seeing in the soft data, Jennifer, is going to bleed into and translate into the hard data. And I'm curious how you're thinking through that.
So again, it's also, I guess that's another version of saying about the consumer confidence numbers and whether or not that's going to pan out into the spending. And we're seeing that also in business confidence as well. When there is so much uncertainty, there's going to be some pullback, I would assume, on terms of how much you're planning to hire, how much you're going to invest. And because again, we don't know how long these tariffs, if they land and how long they're going to land for, how much of an impact they're going to have. So I think that's sort of like the hard data, and that's going to take some time to pan out. Another interesting point I want to make is that you hear a lot of headlines or stories about certain companies bringing investment into the U.S. That's great news. Again, soft data, but that takes time to bring over. Takes time to build the factories, hire the qualified workers. So all that is going to come through in the hard data, but that's not going to be coming through for months to come. Again, depending on what we're talking about. So there is certainly a time difference in terms of how long it's going to take, but certainly all this uncertainty is not great news for the U.S. economy. There's an economic uncertainty index that talks about like the news out there, and it's actually shows how much it's spiked up recently because of all the negativity and all the questions about what's going to play out, and that could become a self-fulfilling prophecy. So we have to be very careful about that.
Jen, do you have sort of a favorite non-traditional economic indicator that you're watching at a time like this to help you sort of figure out maybe something that's more high frequency, as we are sort of just trying to figure out whether and when we're going to see, as we've been talking about, that soft data, show up in the hard data? Are there other things you're watching that you wouldn't normally?
So there's so much data out there, and then of course there's all these questions about how accurate they are, whether or not the response rate is high, and they've been declining as well. But the things that I always talk about, and I mentioned today already, just how much people are spending on the discretionary items, the dining out, the recreational services, and those come out in the retail sales survey, the personal income surveys. That's always interesting to watch, and because again, depending how confident you are or not, how you are in terms of your income. Well, that's another one, income levels, not just personal income, but wages and salaries. I always look at that to see how strong the income levels are coming in, or what speed they are coming into the home. And if you continue to see that steady increase in wages and salaries, like 0.5%, for example, which is the average over the past year or so, that gives me some confidence that the consumer is still in good condition or pretty decent shape. Again, maybe not everyone, but just broadly speaking. So even if they don't spend, at least they put a little bit aside for a rainy day, which is never a bad thing. And it shows that when they are ready to spend and when they're confident to spend, they are able to do so. So I would point to those wages and salaries and spending on different discretionary areas.
All right, we'll keep watching those numbers and keep checking in. Thanks, Jennifer. Appreciate it.
Thank you.